Digital Core Reit and Mapletree Industrial Trust just announced their earnings with both announcing higher DPUs. Both REITs are unique and did correct actions that led to their DPUs going up. So in this video, we'll go through how they are doing it and reviewing their results. For those who are new to MIT, it's quite similar to Ascender's REIT. They are a REIT that manages multiple classes of properties. I will not talk much about this since I've shared them a lot in my previous videos. But in a quick summary, what makes MIT so attractive is due to their high rental assets, which are the data centers, high-tech building, and business parks. Now, looking at their key highlights, it's a very good result across the board, as net property income, distributable income, and DPU came in higher year over year. This is sort of expected as I've mentioned it in my earnings preview video. Main reason was due to new asset contribution of Osaka data centers and good rental reversions. Oddly, they have stopped mentioning about Kallang Wai asset contribution, but I guess it's fine as long as the overall portfolio continue to improve in rentals. If we look at their portfolio performance, I have mentioned about the importance of either occupancy or rental rates have to increase. If we see this quarter, it's very good with rental rates increasing from $2.21 to $2.26. This data is supported by both their renewals and new leases coming in higher. Another good thing is that most of their properties are renting higher than the passing rent. Passing rent is essentially the market rates, and this shows the attractiveness of Mapletree Industrial Trust properties. Let's take a look at their quarter-over-quarter results. Revenue came in lower at 1.9%, but their operating expenses came in even lower at 8.9%. This led to a slight increase in the net property income of 0.6%. Main reason was due to lower property maintenance costs and loss of income from divestment. It's always good that we see the management able to reduce the property expenses, as this is organic expenses. Another good note is that their borrowing costs came in lower at 5.6%, which led to the distributable income coming in higher at 2.4%. So there's a 2.1% increase in DPU, which is very good for MIT shareholders. If we see the note, they have included divestment gain of $13.4 million. However, unlike Mapletree Logistic Trust in my previous analysis video, where they gave out straight in a quarter, MIT likes to gradually give it by splitting over 4 quarters. This is one move which I really like about MIT management, as it brings about stability in the DPU by spreading out, rather than giving all in a quarter. Next, if we look at their debts, leverage ratio went up to 39.1%. But interestingly, even with the higher leverage ratio, their borrowing costs actually went down. While the reason might be due to the Japan yen borrowing, which are cheaper loans. So taking loan in Japan yen now rather than in SGD or USD is cheaper. They have also mentioned about the resumption of DRP program for financial flexibility. So as a shareholder, be prepared to apply for it when the plan has been issued to you. Their borrowing cost of 3.2% is still decent, while the adjusted interest coverage ratio of 4.3 times is much better than most REITs in this high interest rate environment. Why do I always focus on adjusted interest coverage ratio? Is because it includes the interest payment not only from the loans but also perpetual securities. Perpetual securities are similar to bonds, where the REITs issue them and will have to pay the holders the agreed interest. However, they will have some loans that will need to refinance by the second half of 2025. Based on the current environment, interest rates are expected to start cutting in September. So hopefully by the second half of 2025, refinancing will be cheaper for MIT. For MIT, the focus of the occupancy will always be these 3 sectors: DCs, high-tech building, and business park, as their rentals are much higher compared to the rest of the assets. So as long as they are increasing or maintaining, MIT will be in a good place to continue seeing their net property income increase, and of course finally to see them giving more dividends. Overall, for MIT, they are actually doing very well with higher net property income and is expected to continue growing with improving occupancy from their high-valued assets. Moreover, we can also expect Osaka DCs to continue providing more income while new rental leases and renewals continue to do well. What MIT management is good at is that they are confident with their assets, so they do not just lease them cheaply, they rather wait for the tenants that are willing to pay. There is only one concern that I have is that for the US data centers, AT&T lease will be expiring on the 31st December 2024. So unless they find a tenant quickly, they might experience a temporary drop of 3% income. At the current share price, it's priced around 6% dividend yield. I hope that you are finding this video informative so far. If you do, please support the channel by hitting the like, subscribe, and comment on what you feel about the recent Reits results. Thank you, and let's continue with the video. The next REIT that we will go on will be Digital Core REIT. Digital Core REIT just announced their earnings this quarter with decent results. For Digital Core REIT, they are a much smaller REIT of 10 data centers with asset under management of just 1.4 billion. The risky part of small REITs is that each property plays a big part in their property income. So, this risk you will always have to take note when investing in smaller REITs. Looking at their results, revenue and net property income is down 9.6% and 13.4% year over year. But if we compare on the similar basis without the divested assets, it's considered to be up slightly by 1.3%. Good thing is that finance expense has stabilized while there are other expenses which came in lower. This led to higher distributable income of 5.1%. However, DPU declared is lower at 6.3%. Why? Because we can see that the increase in units of 14.8% outweighs the increase in the distributable income. This led to more share dilution and thus lesser dividend per unit. Debt-wise, they are in a good place with leverage ratio of just 34.4%. Even though they have a high cost of debt of 4.1%, their interest coverage ratio is still at 3 times. Like I mentioned before, for REITs currently with high cost of debt but with decent interest coverage ratio, they should do fine. Like they have mentioned previously, they have also been actively doing share buybacks, which is unique as no other REITs are currently doing it. They have mentioned because of the share buybacks, it leads to a 1% DPU increment. But the weird part is that previously they have held private placement where they mentioned that 75% of the cash will be used to acquire the interest in Frankfurt facilities. But yet, they are actually making share buybacks now. The remaining 25% cash was not mentioned, so technically lesser amount of shares could have been issued. But overall, because the share dilution was more than the share buyback, it led to dilution for shareholders and thus lower DPU. So in summary, what are the good pointers for Digital Core REIT? First is the action of doing share buybacks. Share buybacks is definitely always a good thing because it concentrates the shares, making them more valuable for shareholders. Second, their finance cost has started to stabilize and start coming down. So hopefully this is the trend that we will see and thus the net property income should contribute to higher dividends. Third, net property income is slightly up 1.3% if we compare without the contribution from the 2 divested properties. Comparing Q1 to Q2, income is also up thanks to the investment in the ownership of Osaka and Frankfurt data centers. So what are the concerns I have with Osaka data centers? First is of course still the high tenant concentration, as there is a risk that in the event if any of the tenants drop out, they might suddenly lose a huge amount of rental income. Second, Digital Core REIT has a very low lease expiry. Although people say that it's hard for tenants to move for data centers, there's still a slight chance that it can happen. However, this can be good and bad. Bad is the risk of losing income, but the good is that there's a chance for positive rental reversions, which means higher rental income. In conclusion, both REITs are doing well, especially with both having the most valuable assets, and that is data centers. With the increasing demand for cloud storage due to advancement of AI, it's expected that REITs holding data centers will be expected to continue doing well. Thank you so much for watching. If you enjoyed this video, please support the channel by hitting the like, subscribe, and comment on what are your thoughts on the prospect of data centers. You can also watch my previous video on the analysis of Mapletree Logistic Trust or other group REITs analysis. Thank you, and I'll see you in the next video.